Good evening, everybody, or I should say good evening, good afternoon, and good morning, wherever you are. It's 7 o'clock. It's our de-launch webinar for our new structured notes. We're just going to give the community some time to join us before we start. We'll just give it a minute or so.
Cool.
I see there's still some attendees joining, so we'll just give it a few seconds or so.
Cool, Riaan.
Okay, I think still see there's some attendees joining, but we've got so much to discuss tonight, and we've got an hour limit. So I'm just going to kick things off. So good evening. My name is Riaan van der Vyver. I'm Chief Investment Officer at the Global Wealth Group, and I almost want to shout that the structured note is back. And the good news is that our underlying strategy of global banks seems to be the perfect defensive play, given the Russian-Ukraine story, and also all this uncertainty and volatility that we're experiencing in markets. It seems to me, that this global strategy or global bank strategy, we're launching it almost like at the perfect time. So I'm joined by Chad Pope, who's not only a wealth partner, but also head of operations of Cashbox Global. And then Andrew Mobsby, which is the head of product structuring and a seasoned person within the financial services industry. So gentlemen, welcome and thank you for joining us.
Riaan, thanks.
Thanks very much, Riaan. Thanks. Hello, Chad.
Good to see you again.
Chad, before you start sharing your screen, I just want to ask our attendees if there's any questions. Please post it in the Q&A box. I will monitor it, and we will try to keep it as interactive as possible without interrupting the flow. So, Chad, over to you.
Yeah, cool, Riaan. I think it makes a great webinar when people do question, and very happy to answer anything that might come. So, yes, I look after operations, keen on education and sharing information. So tonight's session will be on the specific product, but there's also an opportunity if anybody wants, perhaps through your consultants or directly, for training on how the products work specifically. If you're looking for any extra information, of course, we gladly add that in as you need. So without further ado, I'll share the screen if that's good for you, Riaan.
Yes, perfect. Chad, just before you start, I see Graham is one of our attendees. And to our community, Graham is, I want to say, the combined partner between Cashbox and the Global Wealth Group from IDAT. So, Graham, welcome to you, and I hope you're enjoying your time in the UK with your family. So, Chad, thanks. Let's kick it off.
Great. Yeah, Graham's definitely certainly a huge contributor to what we do, and we're very grateful for this relationship. So thank you for that. And obviously to the Global Wealth Group as well. So just as a disclaimer, this is not financial advice. We can't give financial advice. We don't understand your particular and individual needs and or positions. So this is purely product information for you to use as you see fit. We'll gladly have a chat to you further if you'd like, deeper training, further information with your wealth consultant or advisor, however you fit in. We'll be very flexible. So, Riaan,
I think it will be brilliant, if the community can reach out to the wealth consultants, or if there's external marketplaces to Ruth Coates. They've got all the information.
Absolutely. And then we're there for everybody's support. So the product we're going to chat around tonight, and Andrew will take us through some detail, is an income-based structured note. It's designed to pay out 2.5% per quarter. 10% per annum. There would be some platform fees to come off that, but Riaan, I think we'd ask you to explain that a little later, just so that people get what's all the information that they may need. And this product now will launch on the 11th of March. So it's pretty close now. And this will be income produced as a contract directly from one of Europe's strongest banks, BBVA. So without further ado, I'll hand over to Andrew. He'll go through the product. I'll go through a little bit of the mechanics at the end. And as we say, bomb some questions in the chat. Let's make sure we answer all your stuff.
Thank you, Andrew. Before you kick off, I just want to just make sure that the community understands the strike date of 11 March means by that time the deal needs to be closed on platform, and we need to have the money with BBVA a day before it. The deal, as we speak, is currently live on your marketplace, and it is available for investment.
Fantastic.
Thanks,
Riaan. Andrew.
Right, cool. Hi, everybody. Good evening from Cape Town. Lovely evening here. Great to be back into the marketplace with the team. It's been quite a while. And as Riaan mentioned, we've had a good run with the banking sector. And certainly I'm going to talk a little bit about the current events, which sort of kind of exploded on our screens this morning, although it's been bubbling away, and go back a little bit, probably the last month or two, in terms of what's been happening. So it's quite a busy slide, that. And if you sort of start nitpicking it and pulling it apart strand by strand, it's pretty bad. It seems quite negative kind of energy. You see headwinds, pandemic, inflation, volatility, risk, spending, disruption, challenges. So there's a lot going on in that slide. A lot of dynamism, but it seems to be more headwind than tailwind. If you understand, in terms of these are challenges that are presented to the investment sector. What isn't thrown in there, I need to change my specs from 1.5 to probably about 3 these days. But I think somewhere in there's obviously geopolitical risk. I can see down towards the bottom right-hand corner. And that's really become a huge feature in our lives. A geopolitical consequence is war. It looks as though there's currently one that got underway this morning after a lot of posturing. And I'll deal with that because there's so much being thrown into our sort of collective consciousness through the various media at the moment in terms of this Ukraine-Russia sort of conflict and how far it can go and how it's going to affect us, etc. So I'll touch on that. I think what I want to do is stay with fundamentals. And I want to just take a little step backwards because I'm frankly quite sick of the pandemic. Hopefully it's going to become an endemic where governments treat it more as a flu that comes along on an annual basis. But certainly that's been part of our lives for the last 2 years. We've lived in really extraordinary, very strange, 2 very strange years, starting in sort of around about January 2020 and right the way through to the end of last year, to the end of Q4 of 2021. So very strange times that we haven't been able to adjust to. We didn't know how to adjust to it. We were told what to do. The world has changed, and I think will stay changed in many respects. The future digital space, the space of the future, we suddenly very quickly found ourselves living in. We were there. The future was the present, and the present was the future. And a lot of those futuristic concepts have become part of life now. What we're doing now on a Zoom, reaching people in different time zones, different geographic areas, different places and spaces. It's part of our DNA now. So and so we move on. But the headwinds then were generally about work from home, stay at home, lockdowns, pandemic, vaccines, all that kind of good stuff, bad stuff as it was. And how do we adjust our investing and our economic space and fortunes according to those particular headwinds? And certainly the sort of, I call it the rubber band effect, because the recovery when it came during the early part of 2020, sort of end of Q1, Q2, was led by tech. I've spoken about this digitized space that we found ourselves in, and that literally boomed out. And it was very narrow. In other words, it wasn't a broad recovery across all sectors of all markets around the world. It was driven out of the United States, and it was driven through the high-tech space. Bluntly, as I said to an investor today, the strong became stronger. The big companies became even bigger who were in that space. And they now in a situation where they really, if one of those big monolith titan type tech companies sneezes, the whole market sort of sneezes. And I'll give you an example of that. But we were not dealing with things that are normal to investments. Normal stresses in investments are things like interest rates, are things like inflation. We've had this free money party going on for 2 years, and now the governments are turning off the taps and the party's over. There's a hangover now because we've got things called inflation and interest rates and servicing debt, and we'll talk about those separately. So those are actually normal stresses and strains. What the pandemic did was throw us into a very uncomfortable position that nobody had been in before, or unless you'd gone through the Spanish flu in 1919, which would be very old. But the question is now is that as we approached Q4 2021 and into Q1 of this year, our new year, we'd experienced huge amounts of growth because of all this free money, low interest rates to service debt. It was a bit of a free-for-all. And in 2021, the rubber band effect of the tech guys, the tech companies that had catapulted us out of the abyss, spread out into other sectors because a lot of those sectors, great sectors, were offering huge value. So Cashbox were very early into these recovery value type of players. And one of the areas we really believed there was value was in the banking sector, not financial services per se, but banking sector. So quality, tier one investment grade type of banks. And we've put together during this period, coming off quite a low base in terms of valuations, because these banks had been left behind. They were the bridesmaids. The tech shares had been the darlings. And we got great companies with great balance sheets that made massive provisions for bad debt over and above what they should have done. And that's why they did so well, because as we went through 2021, we started realizing that a lot of these provisions that these banks had made to protect their shareholders, to protect the bank, to protect their balance sheets, their customers, their staff, not particularly all in that order, but it might sound like I'm saying the staff at the bottom end of the feeding chain. But the question was that oversubscribed allocation to things really going wrong. So they erred on being prudent. Nothing wrong with that, typically banking type of attitude. So what they did during 2021 is and you'll see a slide later, they started feeding all this unrealized allocation back onto their balance sheets. So this looked great for profits. So suddenly this number in a bracket, unrealized loss, suddenly came back on the balance sheet, and they started doing very well. But already last year, we were talking about interest rates going up, about inflation, to combat inflation, the party for free money. And obviously, banks do well in this environment. So yes, we were early in. Many of our structures had a 6-month observation in terms of the first order call, the first potential maturity could happen in 6 months, and coming off such a low base. In many instances, this happened. Some of our notes ran for 6 months and they closed. It was the end of the story. We launched 4 banking sector products. And I think, Chad, it was on Monday night that the fourth, actually, the last one actually called. All quality, great banks, but none of them lasted very long and very good coupons. What has happened now is that the banking sector still has got those legs because we are now seeing the introduction of interest rates. So banks are going to now take those added revenues, or put it this way, that profits that they're going to make on people and corporations, institutions, individuals servicing debt is going to flow through as revenue now, not unallocated in terms of the previous issue. So we are firmly of the belief that banks are in a good position, certainly for the next 2 or 3 years. Interest rate cycles move slowly. They don't appear overnight and disappear overnight. They're not like the magic genie. So let's have a look just briefly of what I've been saying is pretty much in the slide. Goes back to January of 21. Nothing moves in a straight line. Nothing is linear in terms of, there's always bumps along the road. But essentially, this does not show the characteristics of, let's say, the tech space, which would show a much sharper aggregate in terms of peaks and troughs on this particular chart. So slow and steady eddy, if you want to call it that, it's quite a nice English term, a slow and steady eddy. They plow along like a bit of a super tanker, doing what they're supposed to do. Now, this was in the pre-interest rate environment. So even then, this is where the unrealized allowances that they've made for bad debt suddenly started flowing back. So they've got that, and they've got revenue coming in from servicing interest rates. So we feel there's a lot of gas left in the sector. We were probably offering a slightly better coupon during late 2020, 21, and I'll tell you why. Was the banks were desperate to attract money, and they were prepared to pay a slightly higher or frothier sort of coupon to attract that. Now they know, they pretty much forecast that these banks are just going to keep going on an incremental upward curve inclination. So they're not going to fall over themselves to pay 12 or 14 or 16%. They'll do that in areas where there's probably more volatility. But this is the US banking, Dow Jones banking sector. It gives you a very good indication of the depth of protection and solidity in this particular sector. Now, banks behave like this. I was doing some research and some work for a client on Facebook. One of the issues of 2020, I beg your pardon, 2022, January. Let's talk about January this year. It's been the worst January in I don't know how long. Okay, and it's right across tech space, the Nasdaq. I actually did make a note of them. I think the Nasdaq was down 9%. The S&P 500, the 500 largest capitalized company on the US exchange, had its worst January since 2009. That's a long period. It runs in more than a decade. And the smaller company sector, the Russell 2000, which is really a broad indicator. It's a good thermometer of what's happening in broad-based corporate America. They had the index fell 10% in January, and again, it was also their worst decline since 2008. So right across the board, whether you were a mega cap, whether you were a small company, startup, you were treated with a great deal of you were examined very carefully. I think what happened was, looking in that rearview mirror, investors started recalibrating their attitude towards risk because inflation, no free money, interest rates, etc. So that became a bit of a pinball. All the markets became a pinball. And I mentioned I was doing some research and some work for a client on Facebook. Now, you'll probably know Facebook has rebranded itself to Meta, which is short for the metaverse. Now, Facebook is one of the trillion market capitalizations. In other words, it's worth more than, has issued share capital of more than $1 trillion. It's one of the mega companies. And yet, let's have just take a look at this, because in 2021 they had an incredible revenue year. They made $113 billion in revenue. That's quite something. That's sort of the GDP of a country, many countries. And yet the stock now, in the last 2 weeks, has been trading like a small cap biotech firm that's just announced a complete failure in one of its drug trials. Okay, because it's just been pushed around. People are shorting it, they're longing it, they're treating one of these huge companies like a small startup company. The only difference between what happened to Facebook and a small company was that it dropped a cool $250 billion in market capitalization. 300 billion it dropped in 2 days. It was the largest value wipeout in American history. That's kind of sobering. Now, a small company obviously would have gone out of business. Facebook is sitting on a lot of cash. Sure, it's taken a 30% knock, and it's going to now have to climb back. It had some impairments, etc., etc. But certainly, what I'm saying is this has covered everybody. This volatility is affecting everybody. Again, strange times. So let's go to banking.
Andrew, apologies. Can I just interrupt? I think the
jump in.
Is, that the banks, being typically high dividend payers, that's providing that
Correct.
protection. And
Correct.
Also, the key point here is, with what you said with the January stock market experience, there's this almost re-rating of risk appetite.
Correct.
And given this volatility and uncertainty, we believe that we're getting this defensive nature of the banks due to, you've mentioned the word quality of earnings. Because typically you get in interest rates, increasing interest rates, high inflation, debt areas, you get the bank's margins being increasing, and that's why this is such almost like a perfect positioning from a defensive perspective.
Yeah, absolutely. You're spot on there. Yeah, absolutely. Yeah, earnings generally, as I said, the last 2 years have been very strange, and I thought as we went into 2022, interest rates, debt, inflation, those are all normal things. And when you go into a more normal sort of space, then you start looking at traditional. I mean, during the last 2 years, the rule books are torn up and thrown out the window. But now we go back to earnings, price earnings ratio, quality of company, quality of orders. What are the earnings steers from the executives? Quarter on quarter, you build a great story. You look at the balance sheet, the leadership teams, and you invest. But yeah, banks are definitely part of that cyclical nature. They're defensive in quality and they're defensive in nature. You don't buy a bank for growth. You buy it for its dividend cover, as Riaan has absolutely articulated. And that's how a lot of people have used banks or high dividends to provide income, as opposed to buying bonds or cash or something like that. The problem with buying the stock directly, if you went and bought Santander, Commerzbank, or any of these banks, or any other bank for that matter, is that what we saw in 2020 is a lot of banks stopped paying dividends simply to protect their balance sheet. So that's not applicable in a note. We use these as a reference basket. We don't own these actual shares. This is the story. This is the underlying reference story. The issuing bank, BBVA, they would have bought these options. Okay, so they buy the options to these shares, and when it calls, they can basically exercise those options into shares and then go and sell them. So that's how the bank makes money. So the issuing bank is very keen for this to end as soon as possible, because their cost of capital is obviously at 10% per annum. They've attracted a lot of money in already. They're happy to pay out and hopefully exit early. And then obviously go and do something with those shares. So, I've always said I've worked for investment banks overseas, in the UK and in Switzerland. They're not charities. They will cannibalize their businesses. I hope there are not too many investment bankers sitting on the call, but they all know the belly of the beast. Yeah, so these are the companies. They are great companies. I think, Chad, if you move to the next screen, it gives you a little bit of a breakdown. There is a full rationale, Riaan, that we can post to you. It has been posted on our website. Breaks it down in terms of the economic environment, the spaces that these banks occupy. But generally speaking, Commerzbank is the second largest bank in Germany. The Italian bank, third from the right, is the largest in Italy. Goldman Sachs, by market size, is the largest. It's pretty much a household name, being an American bank. And then you've got another European bank, Banco Santander, which, when I say European, these are pretty much all global banks in terms of their reach, in terms of where they do business. So very, very solid and very linked to the social fabric also of their specific companies. Graham was on the call the other night and was also giving us some very insightful anecdotes in terms of Commerzbank, which is intrinsically linked to the commercial industrial heart of Germany. We know Germany is an industrial manufacturing monolith, and certainly this bank is involved in most of the commercial transactions in terms of the financing of factories, of products, of process, etc. So very much part of the fabric of a particular country. Santander, again, obviously the Italian bank, and they're broadly based in terms of lending, deposit taking, investments, and that's where we deal with them. So let's have a look at the actual product.
My apologies, if I can just make a side comment, if I may. I think the key point that our community need to understand as well is these, let's call it underlyings that make up the reference basket. It's not just randomly selected. It is selected to support the expected income stream, if I can put it like that 10% before fees that Chad referred to. There's quite a bit of work going into that, research into that, by getting this basket to increase the probability of that income stream.
Correct, 100%. Yeah, it's without going into too much, the due diligence in terms of the matching and pricing and the software algorithms that we work with would probably make most of you glaze over, either in terms of boredom or it gets quite geeky. But the bottom line is a lot of work goes into to make sure that there's a complementary focus in terms of how these banks work either correlated or uncorrelated together. I'll give you a quick simple example. We had two banks in one of our issues last year, and there were two British banks. One was Lloyds and one was Barclays. And the question raised was, why have you got two British banks in competition with each other, number one and number two type of thing, in this space? And we said, besides they're quality companies, the two companies combined had, I think, 60-odd%. It was between 60 and 65% of all British mortgages. Okay. So if either one of those banks had to fail as a business, it would impact on British society. The UK government is not going to allow 60% of the mortgage book to suddenly go up in smoke, or the component that one of those banks owned. So there was another sort of subtle reason. That was one of the stories we built up in terms of why would it be a good idea to hold this, but like Commerzbank now, holding it because it's intrinsically part of the German manufacturing machine that spews out, most of those companies spew out profits and dividends. So yeah, Riaan, there's a lot of little anecdotal stories we could bring to it, but the bottom line is a lot of work goes into that one column when it talks about the reference basket. I'll just touch on quickly BBVA. BBVA is probably about the 15th largest investment bank in the world. It's headquartered in Madrid, but it's got global, North America, Europe, etc. Outside of Europe, it's very well known. Obviously, within Europe, it's one of the sponsors of La Liga, which is like the British Premiership League, soccer, if you're a football fan or addict. But it ticks the boxes in terms of we have to be 150%, if I can use that, in terms of your counterparty who issues this product. They underwrite it in a contract. Their credit and investment committees, it has to pass muster with them before they approve it, because this is an issuance off their balance sheet. If the shareholders, if something goes wrong, the shareholders will murder these guys. So it has to be done properly. It goes through very, very strict compliance and regulatory approval. Besides the fact that one of the startups is you've got to be able to tick those boxes as a tier one grade A investment bank with your Moody's, Fitch, and S&P ratings. These banks are constantly monitored. The coupon that they are offering, or they've structured and underwritten for the period, and this is all based in a contract. Okay, so nothing can change in terms of, oh, well, this has been a bad quarter. They're tied to this. Is 10%, so it's 2.5% US dollars. It's only available in USD. Sometimes we can multi-currency hedge them in normally sterling, but this one is straightforward. The term is 4 years. The bank, yeah.
Andrew, my apologies. I just quickly need to interject here. My apologies for continuously interjecting. Apologies for that. I think the key point here is, as we've mentioned, that the 10% coupon is before fees. So our community members can just go to their marketplace and they will see the after fee cash on cash, or the after fee coupon rate, specifically then to the platform. And just on your BBVA, I think it's worthwhile noting to our community that S&P recently upgraded their credit rating of BBVA. So given all this, let's call it headwinds, S&P believes that there is a lower risk of default, and they've increased the credit rating. Yeah.
Cool.
And that's very, very important. I mean, the re-ratings are normally annually, but sometimes they're semi-annual. I think after the financial crisis of 2008, 2009, regulatory bodies became far more attuned in terms of making sure that people who were offering either credit or debt issuances had the necessary tick boxes. So we're very happy to be able to deal with BBVA. We have great relationships with them at their proprietary dealing desks, and they generally really push out the boat for us when we're looking for something. So the term is a maximum period of 4 years, but that term can be interrupted from the 12th month, from the end of the fourth quarter. Okay, so worst case scenario for an income flow here is that, well, subject to the T's and C's of the Autocall, of the early maturity, you'd have picked up 4 coupons and your capital returned to you at the end of the fourth quarter. So after 1 year, 10% back in US dollars plus your capital intact, as Riaan said, subject to T's and C's of terms. So in terms of the space, very solid. Ultimately, this is defined income. It's not predictable, obviously, but the dates are predictable. The observations are predictable. It's defined. You can't get less. You can't get more. The income trigger is 60%. So what does that actually mean? That means that as long all these shares, those 4 shares will have a start price on a certain date. We price them. And as long as those 4 shares, all 4 of them, are 60% or greater on any one of the quarterly observation dates. Okay, so if all 4 of them are above 60% of their starting level, which will be, as Chad said, in early March, then the coupon gets paid. Okay, 60%. The Autocall trigger, in fact, to trigger the end of the actual product, all 4 must be at 100% of their start price or above, starting at 12 months, starting at the end of the 4th quarter. Okay, so let's look at,
Sorry, maybe for folks that are new to this, I've got a graph coming up just now where we'll demonstrate this.
Yeah.
And when we get into all these technicalities, this is the place where we're very happy to do deeper training. If some of this sounds like a foreign language to you.
Yeah, absolutely.
Thanks for that. And also, if I can just say, we had a deep dive with our wealth consultants, where we fully equip them on all of these to be able to assist. But I think, Andrew, just for our community, the key point of the income trigger at 60% is it means from the initial level, these stocks need to fall by 40% before there's a disruption of income. That's the implication of that 60%. And I think it's important just for our community to understand that.
And Riaan, if you go back to Andrew's first graph of the values of the banks, there was nowhere near anything as a drop like that, right? So highly defensive, as you said in the beginning.
So this, I think the whole issue here is that this is almost a bearish product. It's a defensive product. It works well when there's stress and volatility. That's something that Cashbox Global looks to introduce products that are theme appropriate for the circumstances that we're sort of facing. We've been through the reference basket. We can discuss that further. Capital protection is hugely important because firstly, it relates to the very, very top line, the issuing bank. So during the 4 years or however long it lasts, okay, if it's interrupted in terms of its auto-call, the early maturity at a point in time along the timeline, the capital is underwritten by the bank. That is why it's so important to have a legitimate, creditworthy tier 1 investment bank as your issuing bank. The only time the capital is at risk, well, there's 2 times it's at risk. A is if the issuing bank goes out of business, goes insolvent, then there's a problem. Then capital is at risk. But that's why we are so strong on the pressure testing of who we're working with. Secondly, capital protection at the very last observation date. So this is 4 years, 16 quarters. On the 16th quarter, and you'll see a time schedule, then the 4 companies have to be above, again, 60% of what they started at. Okay, so as Riaan was saying, 100%, you've got a 40% degradation, if you want to call it that. I'm more of a half full glass guy than a half empty glass. I always say we've got 40%. We still got another 60% left in the glass. So sure, that's a huge drop for these banks. For a bank to drop that sort of figure, something has gone horribly wrong in the world. Okay, so
and also what is key to that is it is 40% over a 4-year period. So you almost need to look at 40% over a rolling 4-year period, which decreases that probability, as Chad has said.
Yeah, correct. Yeah, absolutely. Finally, getting into the availability. These products are what known as they closed-ended products. In other words, they open and close. They have a date for subscription, which is there, and Riaan mentioned it, that it is live at the moment. There is one caveat, is that when we structure these, when we hedge these with the investment bank, they give us if I can call it an inventory capacity, an amount, and once that amount is exhausted, then if it comes before the 8th of March, well, then that's pretty much it. They're pretty strict in terms of once it's met, once either the date is met or the inventory is fully subscribed, then there's no Johnny come latelys, if I can call it that, in that respect. Minimum investment size, I think it says $10,000, subject to you guys.
My apologies. So once again, the minimums within our community and our marketplace is different. For example, for the Wealth Migrate marketplace, you can invest as little as $100. So once again, just please go to your marketplace and you will see the applicable minimums there. While I've got the floor, I just got a question for you, Andrew.
Yeah.
People could say, I'm buying this for 4 years, but there's this possibility due to Autocall that this thing can end earlier.
Correct.
What would you say, given the current environment and so on, what's the positives of this Autocall, that Autocall feature? And if I'm not mistaken, the income trigger has a memory feature as well. If you can just touch on that for us as well, please.
Yeah, what I'll do, Riaan, is I'll ask Chad to touch on the memory feature, because it's actually it's pretty well explained in the little graph that we've got. But to come back to the sort of first part of the question, relative to what's the pros and cons of the Autocall. Clearly, the bank builds that in because it would like to get out of this contract at 12 months, but it's really dependent on the markets, the environment, the environmental factors that are going to impact on the reference story on those banks themselves. But in terms of, let's say there is a trigger at 12 months, the investment ends, funds are returned, it gives the client, from a planning and structuring perspective, I would always sit back and say, right, we've had 10% for 1 year in very turbulent times. So we've navigated while other people are kind of either running to the door, crystallizing losses by selling. We've plowed on, we've earned 2.5 per quarter. There's been a steady stream. There may be an income memory feature income situation, which Chad will touch on. But effectively, if it's ended, capital is returned, and it gives you the opportunity to rebase and rebalance your portfolio in terms of what has happened. The world's probably going to be a very different place in 12 months' time. Interest rates will have come through. This drama, and I'll touch on it briefly, in Russia, is going to affect prices at the pump, at the grocery store, etc., etc. It's definitely there's going to be knock-ons. So, the banks might be offering an even greater coupon to attract money, because people might be sitting on cash then. So you might be able to rebase into a higher coupon, but that's an environmental factor that you determine at that point in time.
Yeah, and I think, it is, sorry, Chad, you wanted to say something?
So as an investor in structured notes, what I like about this, the amount of work that Andrew and Idad Graham have done in this reference basket is huge, based on what's foreseen for the coming year, right? Year and a half. Now, if you get that opportunity to not only rebalance your portfolio, because you've got your income and you've also got your capital, you could relook at what the world looks like in a year's time. And Andrew said, the stuff is moving so fast. It's a great chance then to rebalance, readjust, and then go with what's appropriate at that point in time. So I like this. Autocalls work for me, and I think it works for the market. And then coincidentally, across the last 5 years, every product has autocalled before full term. Average period's been about 3.5 years. In the Cashbox structured notes by design, these are closing a bit earlier. 1.5 years is our average, which makes it really flexible and gives me opportunity now to be flexible. So yeah, it's a cool feature. And
I also think a key point is, if it autocalls, it takes this capital protection barrier out of the picture, because then I'm receiving income and I got 100% of my capital back, which I think is also a very cool feature and almost like another peace of mind feature of the structured note. And the reason that the banks also put this in, they're looking for returns, right? So once all these stocks are above 100% of their start price, in other words, they've all grown from their start, that's the chance that the bank has to convert these options into shares, and this is where they make their margin. And they need to make money, we need to make money. And as Andrew said earlier, they're not a charity. So these work very well for everybody involved. Yeah, and I think very important to the community that the investor-facing fees, because of this potential of early redemption or stop, has been decreased, so that upfront cost doesn't have a significant impact on coupon because of the potential of the early maturity or the autocall. So I think that's also just an important point that we need to put to our community. But thanks, Andrew. Thanks. You can move ahead by next slide.
Okay, cool. All right, so what you're seeing on screen now is a typical fact sheet. It's pretty much a nutshell of what I've been talking about, feature products, subscription, product identity, product numbers, etc. I think what's quite important is on your right-hand side, key information. There's your subscription period. There is an inventory, as I mentioned. The issue price is the starting price. That's on the 11th of March. The strike date is when we actually measure what those 4 companies were priced at the close of business. And that becomes the sort of reference base number that we work on. So the 60% get multiplied against whatever the strike is. The actual issue is another work for start. It actually kicks off. It goes live in terms of it's a live product. And that's on the 18th of March. So in as much as we've got to get our cash in and settled and paid by sort of the 8th or 9th, we've got another week or so afterwards. This is, I believe, quite a useful page in the fact sheet. It doesn't look like much, but it tells you something about the nature of this asset class, that it's defined, it's predictable in terms of you've got 16 observations covering the quarters, the 4 years. You've got a start date, end date. Those dates in terms of observation and payment. So you have an observation date where we look at those 4 companies. Are they above 60%? Yes, they are. It's paid a week later. There's the trigger, which doesn't move. This is a contractual term right the way down to the very last one, 60%. You'll see in the auto call column, the first 3 are not applicable because the auto call can only be triggered as of the end of the 12-month period, the 4th quarter. So there it starts at 100%. So there's your first opportunity, and quarterly, obviously thereafter, there's this potential of a liquidity event of an auto call. So you've got lots of opportunity, and the bank wants that opportunity as well to actually end it and exit the contract. It's a contract from the bank side, and it's a contract from our side. Nobody can change it. We're locked in. Bottom right in. Yeah.
Sorry, just for a clarity perspective, given previous questions we had from our community, that payment date is the payment date by BBVA. It's not the date that it reflects in our investors' wallets. Yeah. So from that payment date from BBVA, the money needs to be transferred from the stockbroker into Lemonway. From Lemonway, then there's an instruction given, and then it's allocated to wallet. So our community investors should just expect a lag, if I can put it like this, from this payment date, because that's when the distribution is paid by BBVA. And also just the fact sheet, the term sheet, and the rationale that you referred to, Andrew, it's all available on our marketplaces.
Fantastic.
Yeah, absolutely.
Thanks, Riaan.
Yeah, well said. Yeah. And then bottom right-hand corner there, you've got your very last observations. Your capital is underwritten by the bank during the complete term. If a product did run to term, in other words, if it didn't auto call in any one of the observation periods, at the final observation, as long as those 4 haven't degraded, and all 4, not just 1 or 2, all 4 needs to be at 60% or above, and then full capital is returned. In the event that one of them has fallen below that level, Chad will actually explain. I think the graph is actually quite visually, it explains it quite simply, so we can deal with that there. And the memory feature, which I think is actually the next slide, Chad, if I'm not mistaken.
Yeah, there we go.
So shall I kick the ball back to you?
Yeah, thank you very much. Cool. So folks, what we've done, this is a diagrammatic representation of what's really going on. So on the start date, all 4 shares are going to be measured. This represents 100% of their start price. So let's say one bank, Santander, was perhaps at $100. We're going to measure that stock each quarter, as we are all other 3. And perhaps the stocks rise, or perhaps the stocks even drop. We don't mind, because do you remember we had the income trigger set at 60% of its start value? So what's brilliant with these products, Riaan, we're actually investing with a guarantee or an insurance put in place that even if the stocks in that underlying basket drop by 40%, we are still in the money. Each quarter is going to pay out. So quarter 1 pays out, quarter 2 pays out. So what happens in the event that one of those stocks breaches that 60% barrier? Let's say it comes through, and at quarter 3, we are below the 60%. What happens in this case, that coupon is put on hold. It's not lost. And what's amazing is that the next quarter, let's say quarter 4, when the shares are above the 60% mark, I get quarter 4's coupon, plus it looks back and will pay me this coupon together with quarter 4. So while we may not receive it for that quarter, it'll pay out over here. That's highly, highly unlikely, but it's another form of insurance, if you like, that's built into the product, which is the reason why so many trust companies around and community are using these for predictable income flows. So if we bought banks, for example, for dividend yields, and we were looking for, I hope Andrew's okay.
He's so excited about this product.
So,
Andrew, we heard you jump for joy there in the background.
Yeah.
Yeah, no, I'm still here.
Go Fido.
Seatbelt is on.
All right, great. So then, folks, from quarter 4, this autocall level is put in place, and this is set at 100%. So if all 4 stocks are above their start price at quarter 4, like over here, this product, the bank would then want to exercise their options, convert the options on those shares to actual shares potentially, sell them back into their investment bank, and this is where they make strong money. And they're happy to use our money and pay us 10% using our funds to buy these options. And in that space, they then make their returns. Because you would say, like, how is it that a bank would pay this kind of money, right? If I deposited money with a bank today, probably going to get 0, particularly in dollars. And the reason is they're using these mechanisms now to actually use our money to create more money. And this is what banks have been doing practically since they were invented, Riaan. And what blew me away, I only got to know about structured notes some 5 years ago. Andrew's been creating these products together with international structures like IDAD for 20 years. These have been around. So it's not a new invention. It just was never available, which is brilliant. So just for everybody's interest, the past 5 years, all the income-based structured notes have all auto-called as designed. So they've actually never got to the capital protection barrier. But let's chat about that now. Let's say one share closed out at the end of 4 years, highly unlikely, let's say at 80% of its start price. It was 20% down. As long as I'm above the 60%, my full capital comes back. So where in the world can you get to invest in shares, stocks, directly or indirectly, with this level of protection? So now we've got banks, we've got this protection built in, we've got memory feature, we've got coupons, we've got all this good stuff in order to generate a very defined and hopefully predictable income stream. Cool, eh?
Very cool. I mean, and in essence, just using an example, in Q3, if it's below that 60%,
yeah,
and in Q4 it's above,
yep,
investors will still earn their 10% per annum. It's just the case that in Q3 they didn't earn anything, but the memory feature kicks in, and they still earn their 10% for that period.
Right. So no matter what happens through the life of the product, when it auto calls, it would have paid its full coupon plan. Most amazing product. Now, it's not to say that this could never not produce. Something could go wrong. It is what it is. But if you look at the track record, this is a lovely place for defined income. So we work in a highly regulated environment. IDAD, together with Cashbox, which is really Andrew, Graham, Raina, they look at the market, they design a product. It then goes into the investor community. Once the bank says, hey, we really love what you've designed, we would like to take this on board. We're very happy. We'll give you an allocation. Let's say it's $500,000, $1 million to go and then market the product. We get a raising fee for the work that we do. The investment bank then issue the contract, and investors would come through an investment platform like Global Wealth Group. And this platform then is the platform that interacts with the bank. They don't interact with the individuals directly. It goes through the investment platform, and the funds only ever flow between the investment bank and the platform. And then whenever the investor wants to or from their platform. So highly protected, highly regulated global structure. We love advisors. We love chatting to advisors. We love chatting if there are any questions to individuals and or advisors. What a lovely setup, making this fee light and really strong and predictable in terms of its growth and returns. So Riaan, I think that's it. We'd love to answer any questions, and if there's anything more to go through, we're in your hands.
Yeah, so Andrew, I just caught you there off camera. We got a question, and I'm going to start just maybe Chad to pose it to you first. We've got a question from Danny Hell. So if one of the stocks in the reference basket end below 60%
Yes.
of initial value, what happened to the capital? I think if you can just quickly re-explain that for us, please.
No problem. And was Daniel referring to like Q3 or right at the end?
No, at end of the at the last observation.
When last did you do a webinar and there was a B in front of you guys? Sorry, Daniel. All right. So what's going to happen if all the stocks are above 60, let's say it's 62% of their start value, you'd get your full capital. If one of the shares closes out below 60, let's say at 58%, I'm not going to get all my capital out. I'm going to get 58% of my capital out. So there's another form of protection built in here. You're not going to lose all your capital in this scenario, but you won't get it all back. This has not happened, but that's contractually it's structured into the contract that should that unlikely event happen, you'll get the lowest share percentage back of your capital.
Excellent. Thank you. Thank you for that. Then, Andrew, based on the Russian invasion of Ukraine, we've got a question. Investment specialists, which I hope we form part of, are declaring a run to cash and gold with the situation in Eastern Europe. Does the panel believe now is the time for structured notes with capital preservation as a key part of your combined portfolio strategy?
Lovely question.
Yeah, a very good question. I mean, yeah, these are unprecedented times. This conflict, even though it's based in Eastern Europe, has got a global fallout. It's as simple as that. You know, all the continents are involved. If one takes just a snapshot at what happened across markets today when the invasion per se started, everything is down. Everything, some instances markets are entering corrective territory, bear territory. The Russian market, if anybody has followed the Russian market, has lost 35%. Okay, that's the Russian market. But generally speaking, I mentioned earlier, yeah, there's going to be an impact at the pump. The Ukrainian area that's being invaded is a breadbasket of agriculture. It's one of the biggest wheat producers and exporters in the world, as is Russia. The same goes for energy. A lot of Europe, Western Europe, is highly dependent on the energy, specifically oil and specifically liquefied gas, specifically Germany. So there's a lot of pressure. A lot of people are saying maybe this war is an economic lever in terms of concessions, etc. But long term, the situation is like an economic cycle. A war has a cycle. Nobody knows where Mr. Putin, who seems to be quite a good poker player, because he lied to everybody and everybody believed him that no, he wasn't going to do anything. And I think everybody thought he was going to do it, but nobody said it. The fact of the matter, it's happened. The uncertainty, and that's probably what markets hate the most. Whether you're at a stockbroking level, institutional asset manager, money manager, fund manager, crypto manager, doesn't matter. The one feature is, I call it FUD, fear, unease, and doubt. It means uncertainty. If there's no certainty, people aren't sure what's happening. So the war has now started. So yes, there has been a flight. There's been a sale of equities. People are selling, they're crystallizing losses, and they're taking out of their portfolio and moving to typical safe havens, such as commodities as gold, silver, some instance platinum, US currency even has seen, I was watching the US Treasuries today, a lot of inflows. So yeah, it's even bonds, which I'm not a great fan of, have seen some inflow. So typically people are de-risking. They're saying, I don't want to be in equities. I'd rather de-risk and go off the table. So the issue with the structured note, and it's a great question, is that the structured note uses, in our structured notes, uses reference baskets in equity plays, in thematic plays. So we are using banks in this particular space, okay? A war is not helping anybody. It doesn't matter where you're at. And possibly the volatility that will cause right across markets will also impact. But when this product strikes is effectively what, it's over 2 weeks away. And that's where we need to get the cash in to be invested. You're probably going to see more attractive entry levels. You know, I'm not being blasé or facetious when I say I see a glass as half full, not half empty. I believe there's going to be really good, attractive entry level prices to access these banks, which have actually grown really, really well. Everything is going to be repriced slightly. And again, you're going to be getting at a lower level. A good example was this, what happened in February, March 2020, when world stock markets just went down a complete mine shaft. Within the space of 3 weeks, we saw this major collapse. So if you'd sold, got out and crystallized, you would have had a problem. We were launching during that period. No bank would even issue a product. The banks weren't even interested in issuing products because they were protecting their balance sheets. They didn't know where it was going to end. But once they realized a bottom had been, or bottom out to a degree, they were very keen to attract cash. And we were then accessing these fantastic companies, Apple, Amazon, Tesla, you name it, at prices that we hadn't seen in a long time. And that is why the prices rose so fast incrementally on the rubber band that we had to unfortunately end those contracts were ended sometimes after 6 months, after 12. So yes, we don't know how long this conflict is going to last. And wars generally don't suit investments. Yes, money can be made. I mean, during the Gulf War, for example, here's a question, file 13 or whatever the question is called. What was the most profitable company during the first Gulf War? A lot of people thought, well, a jet company or who makes boots or bullets or aviation gas or something. No, it wasn't that at all. You put 300,000 or 400,000 Americans into a desert, they get very thirsty. It was Coca-Cola. Not that they were drinking Coke, they were drinking bottled water that was flown in by super freighters from Germany. But bottled water had to be bought in. So you can make money in these scenarios, but we are looking at not making the kind of money on a speculative basis. We are contracting with a great investment bank with a great underlying story. And if we can access those share prices at a lower level, well, then believe you me, that 12-month period out for the first order call would mean we've got less work, or the shares have less work to do to order call. It's as simple as that. But yeah, it's a troubled area. It's a troubled time, should I say, in terms of diversification. I always believe diversification is key. And certainly this is one way of keeping invested, but with protection. You're not unhedged. This is a hedged product. You've got the capital protection of a fantastic international bank. You've got the defined contribution, the defined return via contract, as opposed to being in an unhedged position, let's say holding those banks or holding any other stock and being subject to the pinball kind of effect that you're going to be subjected to, because it's going to be bumpy. I think the markets are going to be bumpy. It doesn't matter where you are in the world, whether you're an Australian investing in the Australian markets, South Africa, the UK, we're all being affected. This is a global pandemic in finance caused by uncertainty about where will this stop. Will he stop at the Ukraine or will he go further? Some people said, well, the West has been very squishy in terms of its response. He needs to meet something hard. So he needs to maybe meet with steel and then maybe it'll stop. But it is worrying, by way of illustration. This is a bad precedent. If they're just slapping his hand with economic sanctions, it's probably going to hurt the West as well. But 2 weeks ago, the Chinese premier and Putin signed an accord at the closing of the Olympics, the Winter Olympics. And I said, I'm not a conspiracy theorist, but I do modeling in terms of scenario planning. And I thought, I wonder if the Chinese are watching this quite carefully to see where the West will stop I mean, they didn't stop it when he took Crimea. Maybe they're not going to stop it now. Maybe China thinks, well, hang on, maybe we should try this with Taiwan. It sets a dangerous precedent. It could set a dangerous precedent. So it's not for me to say this is going to be over in 2 weeks, and then he'll pull his troops out and we'll all go back to business. Europe has changed. It's going to be a hardened relationship now in terms of almost going back to Soviet era. So it's going to be a very interesting place, but there's going to be bumps. Again, no linear movement. But this is one way of protecting your investment. There's always a place for an investment in the open, unhedged market. You know, you've got your Disney shares or your Harley Davidson shares or your Boeings or whatever. But this is designed to deliver contractually what the T's and C's set out to do. So it becomes part of your components. Have you got that slide, Chad, where it shows where they fit, where it fits in a portfolio? That's quite useful.
No, I don't
Oh, okay.
unfortunately, but maybe just to add 2 things, Andrew. And Riaan, one of the reasons that I love the global wealth, medical buildings, etc., similar to this, there's a contract with a tenant, there's contracted income, you understand where you are, there's a high level of predictability. This delivers exactly the same. And I don't know if you know, but we had 8 products running through 2020. Not one of these actually interrupted the coupon flows. While we did have a very steep drop off and we could have broken through and come back out, remember this product's running for 4 years. So hopefully whatever's happening in the world gets sorted out. We need only get to our start price in a year and this product is already closed. So yeah, these are great products to add to a predictive income stream, as are your properties.
Yeah, definitely. I mean, I think a key point that I just want to make is, is where Andrew mentioned about the entry level. So if a banking stock now is trading at $10, and because of all this uncertainty, it drops to 8, that's the initial level. So there's almost like a further protection building, if I can put it like that.
Yeah.
The second key point is, this is already, it's out in market. So it's not that the bank now, because of given uncertainty, can change the terms and conditions. So that's the beauty of this. We're getting this predictability and this defensiveness in the world of this uncertainty, which I do believe, from a diversification point of view, cash in the US is giving you a very low yield currently, maybe 1%.
Yeah.
So you're getting the predictability at a higher yield. Gold is always a safe haven, but from a diversification perspective, I think there's definitely, from the defensive nature, a place for the structured notes as part of capital preservation.
And how crazy you say defensive and it's still 10%.
Yeah, I'm an economist and they say there's no such thing as a free lunch, but it seems to me we're getting a starter here for free, kind of thing, if I can put it like that. So, gentlemen, I think we're at the hour. We've answered all the questions. Oh, sorry, I see Danielle's got a question here. What happens if one bank missed 2 quarters? I think the key point here, Chad, if you can just talk about it, although it's based on one bank, it's still a reference basket. Yes,
so really what we're looking at is the worst performing of all 4. And even if we missed 1, 2, 3, 4, 5, 6 quarters, it doesn't matter, because when we get over that and above the 60%, even if it's quarter 7, so it's going to pay them all back. So yes, we are always watching the naughty child in the basket. Who's the lowest?
Exactly. So in other words, it's almost like accumulating, but it's not being paid until the next income is triggered. Then it piles up and it pays out.
Yeah.
Yes.
Correct.
Excellent. So I think we've answered all questions. We're at the hour. So Andrew, Chad, it's been marvelous having you on the Deal webinar. It's been a privilege. We are very happy to be back in the game with a sponsor like Cashbox Global. Graham, if you're still part of the participants, thanks for that great relationship and for the work being done by IDAT in the background. So just in closure, we've got a structured note with 3 components. You've got income, with a memory feature that pays 10% gross. You've got Autocall, which potentially means that this structured note could end earlier, which then means that you get 100% of your capital back. And then if it runs the full 4-year period, then there's this capital protection barrier. So you've got a 10% coupon before fees with levels of protection and a defensive nature. So I thank you all, and you must have a wonderful evening, and thank you for your time.
Riaan, thanks so
Thanks,
much.
Riaan. Cool.
Thank you. Thanks a
Ciao.
lot.
Cheers, everybody.
Bye.
Bye.
Ciao.